Hey everyone, and welcome back to the channel. If you've just started your investing journey, congratulations. You've taken one of the most important steps toward building real wealth. But here's the tough truth: the path to building wealth is paved with mistakes. And for beginners, a few simple, common errors can completely kill your returns. We're talking about turning a potential millionaire retirement into, well, a lot less. Now, I've made some of these mistakes. Every successful investor has. The key isn't to be perfect, it's to be smart. Today, we're breaking down the 7 most common beginner mistakes that sabotage your portfolio, and more importantly, the simple, actionable strategies you can use to avoid them. Stick around, because mistake number 4 is the one I see on social media every single day. And it's costing people fortunes. Let's get started. The very first, and arguably the most destructive, mistake is emotional trading. This is the classic, buy high, sell low, trap. It's driven by the 2 most powerful emotions in the market, greed and fear. When a stock or the market is soaring, greed kicks in. You see everyone else making money, you hear the hot tip, and you jump in, usually right as the price peaks. This is chasing returns. Then, when the market drops, fear takes over. You see your portfolio value plummeting, the news is all doom and gloom, and your instinct is to sell everything to stop the pain. But what you've just done is lock in your losses. You sold at the bottom. The fix, the rule: adopt a disciplined, long-term perspective. If you don't need the money for at least 5 to 10 years, short-term volatility shouldn't matter. The stock market's history is a long line of recoveries. Don't panic sell. My best advice: implement dollar cost averaging, DCA. This means investing a fixed, consistent amount of money on a regular schedule, say, $100 every month, regardless of what the market is doing. This system removes emotion, forces you to buy more when prices are low, and historically delivers much better results than trying to guess the next market move. Mistake number 2 is the classic: not diversifying, or what I call, all your eggs in one basket. Beginners often get excited about one specific stock, maybe their employer, a trendy tech company, or a friend's guaranteed winner. They dump a huge percentage of their savings into it. It feels like a high-reward strategy, but it's actually incredibly high risk. If that one stock or sector has a bad year, your entire portfolio is crushed. You are taking on uncompensated risk. You're not being paid extra for taking that much risk on a single company. The fix, the rule: diversify, diversify, diversify. You want to spread your risk across different companies, different industries, and even different types of investments, like stocks, bonds, and maybe real estate. The easiest way for a beginner to do this: index funds or ETFs. These are baskets of hundreds, even thousands, of different stocks. By buying a single S&P 500 index fund, you instantly own a tiny piece of the 500 largest companies in the US. That means if one company fails, the other 499 are there to pick up the slack. Instant, low-cost diversification. It's the closest thing to a cheat code in investing. Mistake number 3 is subtle, but over decades, it can silently steal hundreds of thousands of dollars from your future wealth, ignoring fees and taxes. High fees, particularly on actively managed mutual funds, can absolutely crush your returns. Let's say Fund A has a 1.5% expense ratio and Fund B has a 0.04% expense ratio, which is common for index funds. That tiny 1.46% difference might not seem like much today, but compounded over 30 years. It's the difference between retiring wealthy and retiring just okay. Then there are taxes. Beginners often invest in a standard brokerage account when they should be prioritizing tax-advantaged accounts like an IRA, a Roth IRA, or a 401k. The fix, the rule: always choose low-cost index funds or ETFs. Anything with an expense ratio over 0.5% needs a very good reason to be in your portfolio. And second, max out your tax-advantaged accounts first. The tax savings alone, whether it's tax-free growth or a deduction today, are a guaranteed return that you simply can't afford to pass up. Don't pay the taxman more than you have to. This is the mistake I mentioned in the intro, and it's ramped up due to social media, chasing hot stocks, crypto fads, and the fear of missing out, or FOMO. You see a company jump 500% in a month. You hear a celebrity talking about a new crypto coin. You jump on Reddit or Twitter, and everyone is hyping the next big thing. It feels like easy money. But by the time you hear about it, the smart money has already made their profit and is looking for the exit. You're left holding the bag. This ties into trying to time the market, the fool's errand of trying to predict the exact peak and trough of a market cycle. No one, not even the experts, can consistently do this. The fix, the rule, your mantra should be, time in the market beats timing the market. Forget the noise. Forget the lottery ticket stocks. True, generational wealth is built slowly, consistently, and boringly. Stick to your long-term plan, focus on blue-chip companies or broad index funds, and invest consistently. If you must speculate, maybe you have a passion for a sector, create a small, separate, play money account, say, 5% of your portfolio, so your mistakes there don't derail your core strategy. Mistake number 5 is like getting in your car for a cross-country trip without a map, not having an investment plan or clear goals. Why are you investing? What's your time horizon? Is this money for a house down payment in 5 years, or retirement in 30? These questions must determine your strategy. A beginner often invests too conservatively when they're young, or too aggressively when they're close to retirement. If you're 25 and investing for retirement, a market crash is just an opportunity to buy stocks on sale. You have decades to recover. That means you can afford to take on more risk for higher growth. If you're 60 and retiring in 2 years, you need to be much more conservative to protect your nest egg. The fix, the rule, define your goals and your time horizon. Write it down. Your investment portfolio should be a reflection of this plan. This also helps with the emotional trap. When the market is crashing, you look at your plan and remember, this is my retirement fund. I don't need it for 25 years. I will stick to my plan and keep buying. Your plan becomes your shield against fear. Mistake number 6 is a failure of maintenance, neglecting to rebalance. Let's say you started with a perfect portfolio, 80% stocks and 20% bonds. A bull market hits, your stocks do incredibly well, and now, without you doing anything, your portfolio has drifted to 90% stocks and only 10% bonds. You've become much riskier than you intended. You're now overexposed to the stock market. You need to rebalance. Rebalancing simply means selling some of your winners, the stocks, and buying more of your losers, the bonds, to get back to your original, intended allocation. The fix, the rule, rebalance your portfolio once or twice a year. This forces you to do 2 smart things. 1, it automatically sells high and buys low, and 2, it ensures your portfolio's risk level is always aligned with your goals. It's a risk management tool that beginners often overlook. The final mistake, and it's a huge one, is the sin of inaction, specifically, waiting for the perfect time to start investing. I hear it all the time. The market is too high right now. I'm waiting for a crash. I don't know enough yet. This is just another form of trying to time the market, and it is the single greatest destroyer of returns. Why? Because you are missing out on the single most powerful force in finance, compounding. Compound interest is where your earnings start to earn their own earnings. It takes time for this to kick in, and the earlier you start, the more time it has to work its magic. The fix, the rule, start now. Even if it's just $50 a month, the most important dollar you will ever invest is your first dollar. Time in the market is your greatest asset. Don't let fear of imperfection keep you on the sidelines. So, those are the 7 mistakes that most often derail a beginner investor. If you can master just these few, fundamental concepts, you will be miles ahead of the vast majority of people. Investing is a marathon, not a sprint. Be consistent, be patient, and be smart. If you found this video helpful, please hit that like button to help this video reach more people. Subscribe if you want more no-nonsense personal finance and investing advice. And let me know in the comments, what was the first big mistake you made when you started investing? Let's all learn from each other.